Right here is a perfect trade setup that is very accurate. While other traders were drawing random support lines hoping they'd hold, this indicator clearly showed buy power at 73% in the support zone and sell power at 81% in the resistance zone. What's even more impressive is how this indicator doesn't just show you support and resistance levels, but also calculates the exact buying and selling pressure within each zone. And in this video, I'm going to reveal this indicator to you, the exact settings for maximum accuracy, and 3 powerful strategies that turn these power readings into consistent profits. Let's get into it. To add this indicator to your chart, first, head over to TradingView and pull up any market you want. I'm using the 15-minute time frame on GBPJPY, but this works on any time frame and any market. Click on indicators and type in support and resistance power channel. Make sure you select the one by chart prime. Unlike most indicators that just draw random horizontal lines hoping they'll hold, the support and resistance power channel uses advanced calculations to measure actual buying and selling pressure within each zone, giving you precise data on where institutional money is positioned and how strong each level really is. Now, when you take a closer look at this indicator, you'll see it's made up of several powerful components. First are the dynamic support and resistance zones. These aren't just static lines. They're adaptive channels that identify the highest and lowest prices within a defined range, automatically adjusting to market conditions and extending into the future for forward-looking analysis. But where it gets supercharged is the buy and sell power calculations. Within the upper resistance zone, the indicator calculates sell power based on the number of bearish candles and their intensity. And within the lower support zone, it calculates buy power based on bullish candles and institutional participation, which means the higher the percentage, the more institutional money is committed to that zone. Most traders struggle because they rely on random signals without a clear system. That's why we focus on structured strategies and automation, so you can study how these tools work step by step without guesswork or emotions. If you want to learn more and see exactly how these strategies are applied in real market conditions, click the first link in the description. Now, to get the most accurate signals possible with it, let's get your settings right. Double-click on the indicator to open the settings panel. You'll see that the default length is set to 130 bars. I've found that adjusting this to 100 gives you much more reliable power calculations for most time frames, because this longer period captures a broader market structure while filtering out retail noise. Next, you want to adjust the extend parameter from 30 to 25. This extends your support and resistance zones further into the future, allowing you to see where institutional levels will likely hold even before price gets there. Under top and bottom colors, I recommend using bright red for resistance zones and bright green for support zones, as this creates instant visual clarity when scanning multiple charts. Next, make sure show power values is enabled, as this displays the critical buy power and sell power percentages that make this indicator supercharged. Then enable delayed signals to activate the 2-bar confirmation filter, as it prevents you from entering on false breakouts that trap most retail traders. The power calculation algorithm analyzes candle bodies, wicks, and volume intensity to determine the true institutional commitment within each zone. So, when you see buy power above 60%, you're looking at zones where smart money is accumulating. And when sell power is above 70%, it indicates zones where big players are offloading positions. Once that's done, click OK. Now that your settings are calibrated perfectly, here's the exact step-by-step strategy that turns these power readings into profits. Strategy 1 is power zone reversals. For perfect long entries, you need 3 specific conditions to be met. First is to confirm high buy power in the support zone. You want to see buy power readings of 65% or higher, a signal that massive accumulation is happening at this level. Next, wait for price to approach the support zone and show rejection. Look for long wicks, doji patterns, or engulfing candles that demonstrate buying pressure defending the level. The delayed signal markers will appear as green diamonds when conditions are optimal. Third, confirm the midline retest pattern. Price often bounces from support to the midline dotted line before continuing higher, so this gives you a precise target for partial profits while letting the rest run. Now, when all these 3 conditions are met, enter your long position when the green diamond signal appears, with buy power above 65%. Set your stop loss below the support zone, where buy power drops significantly, and target a 1-to-3 risk-reward ratio. Strategy 2 is the power breakout momentum. For breakout trades, you want to focus on the power differential, when sell power in resistance exceeds 80% and buy power in support drops below 40%. It signals that institutional selling pressure exceeds buying interest. This creates high probability bearish breakout conditions. Now, wait for the delayed breakout signal, which appears as red arrows below the broken support zone. Enter short positions only after the 2-bar confirmation period to prevent false breakout traps that catch retail traders. Now, strategy 3, the midline power scalping, is the most profitable of the 3. It uses the midline dotted line combined with power readings. When price is between support and resistance, the midline acts as a magnet. So if buy power is strong at 60% plus and price approaches the midline from below, this creates perfect scalping opportunities to the resistance zone. The power calculations show you exactly how much institutional interest exists at each level, turning what used to be guesswork into mathematical precision. For scalping setups, enter when price touches the midline with confirming power readings and use use tight stops just beyond the midline. These scalping trades often complete within 2 to 4 hours, making them perfect for active traders who want quick, high-probability profits. Before I show you the next strategy, remember this: learning indicators is one thing, but applying them within a structured process is what really matters. That's exactly why we've created a place where you can review these strategies, see live examples, and study them in real market conditions. Just click the first link in the description whenever you're ready to explore further. Now, different markets require different settings for maximum profits. For forex pairs, keep the length at 120 to 130 to filter out session manipulation and bank noise. Reason is that forex markets have institutional games during session overlaps, so the longer calculation period captures genuine support and resistance levels. Also, look for buy power above 70% during London Open and sell power above 75% during New York Close when institutional flow is most reliable. For crypto, bump the length to 150 to 180 to handle crypto's extreme volatility. Because crypto moves are driven by retail emotions and whale activity, so you need longer periods to identify meaningful zones. Plus, only trade when buy power exceeds 75% or sell power exceeds 80% due to higher volatility. For stocks, keep length at 130 to 140 for SPY, QQQ, and broad market ETFs. Focus on the midline strategy during regular market hours when institutional volume is highest. For futures, use length 140 to 160 for commodities like gold and oil, because futures have natural institutional flow cycles, so longer periods capture accumulation zones. Pay special attention to power divergences during major economic announcements when institutional repositioning occurs. For gold trading, set length to 180 and extend zones by 30 bars to account for gold's unique volatility patterns. Gold exhibits explosive moves, but also long consolidation periods, and these settings ensure you're catching the institutional accumulation phases before the big moves happen. Thanks for watching, and I'll see you in the next one.